Welcome, everyone. We're on to, I believe, our fourth episode in the early days of Ethereum series. I'm Kieran James-Lubin, CEO of BlockEpps, joined with my co-founder, Victor Wong, Chief Product Officer at BlockEpps, and Julio Faura. We've known Julio at least since 2016. Quick touch point in 2015, but let's say 2016. And blockchain OG. I spent 11 years at Santander, where he led R&D and the blockchain practice. And in addition to holding several corporate leadership roles in the investment banking, consumer finance, and IT divisions of the company. Prior to that, 6 years at McKinsey, advising leading financial services firms in Europe and LATAM, and playing a leadership role in the financial services practice. Started a career as a chip designer and system programmer. Pretty cool. Rare to see, that level of technical expertise crossing with, the big enterprise, big bank experience. Plenty of people can do one of the two. Hard to do both. Founding chairman of Alastria, which actually maybe we should cover a little bit about what Alastria is at some point. Board member of the Wall Street Blockchain Alliance and co-founder of the Utility Settlement Coin project.
Kieran, you said as we said, we've been longtime friends, worked together on many different things. But I think there's probably no one in the world that understands the background of institutional adoption of Ethereum technology as well as Julio does. You've been in it from the beginning, and you're still in it. So really excited to talk to you about it.
Quite a ride, I would say. But yeah. I mean, we took this path, right, of helping enterprises adopt this, and it's long, right? Because enterprises, and particularly regulated enterprises, as in banks and FMIs and central banks, have their own definition of what it means to be ready to go into production. So yeah, quite a ride, but getting there. Quite interesting times right now. So anyway, and thanks a lot for having me. I'm very honored to be here today.
Of course. Maybe we should start there's parts of this story that I wasn't there for, that I knew you and Victor were working on personally, but we'll start a little bit before that. So I guess what got you personally interested in Ethereum, and roughly around what time frame, or were you looking into it kind of pre-launch, as I know we were, and I think that was actually common in those days, or was it around the launch? And then how did that go within the bank? So were you sort of the main advocate for looking at blockchain technology? Was there groundswell of interest, kind of, et cetera?
The bank at Santander, we were starting to take a look at innovation more broadly. You may know Santander had a very long past of execution, as in buying all the banks and integrating and reaping the scale efficiencies and so on. But at some point after the crisis, right after the credit crisis, etc., it was difficult to keep growing on an acquisitive way because of the the new capital constraints, etc., that they imposed on banks. So it was time to go back to see what how we can get more bang for the buck, let's say, right? And at that time I was investing my time on innovation. We put together a proper innovation practice within Santander, and I learned and at that time I learned about blockchain, and I thought that blockchain had the potential to really help banks be more efficient and transact better between each other, or with others. And the beginning was interesting because at that time there was only Bitcoin around, right? I was one of the first, I can pride myself of being one of the first that started to talk about blockchain as a potential transformation tool rather than crypto, right? Bitcoin and crypto. There's a famous anecdote. I was advising a startup that did some kind of it was like an experts network, like like a LinkedIn for the advisors or consultants and things like that. So this was a friend of mine I was an advisor of, and he asked me to put together a small challenge, right, to go find these consultants. And that's how I met John Whelan, actually, because John
okay.
responded to that challenge. And the challenge was about understanding the implications of blockchain, not Bitcoin, for banks, right? And somehow, I mean, the report was great, and this was very early days and all of that, but somehow this was filtered to the press. And then, the words Julio, Bitcoin, Santander appeared on the same headlines. And I got all kinds of calls from our PR department and, compliance, and everybody saying like, what are we doing with Bitcoin and so on. So anyway, back in the day, it was all very, very promising. Ethereum appeared as kind of the next stage, right? The next phase, the next screen in all of this, because of the introduction of the smart contracts. So this actually, because at that time we only had Bitcoin, we only had Ripple. Ripple had announced this. How was it called? There was supposedly going to be like a smart contract language as well, and all that.
Codius.
Yes.
It's called Codius.
Yeah.
Codius, that's it. Yeah, I was
I
trying
think it
to
never really saw the light of day. I think they released
Yeah.
it and then they sunsetted it pretty quickly.
Yeah.
There was interesting architecture at the time, like to kind of layer a smart contract layer on top of Bitcoin type, functionality. So.
No, anyway, so it was, and Ethereum was just so practical. It was and it worked, right? And it was among all. I mean, it was very easy to understand. Right? You could understand. You could see, and so anyway, I was very, very interested by the computing paradigm. Right? You could build applications very, very quickly. I even wrote myself the first ones, including tokenization and payments and all of that. So yes, we started to experiment with that, and it was really quite remarkable, right? It was very, very versatile, very easy to understand. It was possible to start using it and so on. It was harder because we didn't have like consensus algorithms. We only had like proof of work, and it was a little bit onerous at some times, and it did have, I mean, Geth did have some memory leaks and bugs and all this thing, but the concept was amazing. So that's when I really fell in love with the concept and started to think seriously about the potential applications.
I'm kind of curious about your innovation hub, because of the two probably earliest banks that were I'm kind of looking at blockchain in general and Ethereum in particular, were like Santander, which you set up, and JP Morgan. And it seemed like both of you guys had actual developers working for you as part of that structure, because not every innovation hub has that. And I'm wondering, how you came to that structure and why that happened.
So I was very fortunate to have a great boss that was very powerful within the bank and very very wise. He was the former head of IT and operations that left that to become the head of innovation. And he was very conscious that if we tried to do these things on a theoretical level, or if we tried to do this kind of within the same structure of the bank, then it would be impossible, right, to properly experiment, right, and try new things. So he lived, he gave me and he gave us a lot of leeway, right, to experiment and have a few resources. I mean, Santander is a very frugal place, right? We take, I still say we take a lot of very seriously the efficiency, let's say, but it's possible. I mean, you have a vision to actually do things. So yes, I mean, we ended up putting together, programmers, resources. We put them as part of our team. We also collaborated with the IT people. The IT people were very keen and very supportive. They did give us the right resources to be able to work on a separate way, let's say, to the mainstream way, just for the case of, for the sake of innovation. And then once we had concepts ready to be tested in a little bit more seriously, kind of in pre-production or in limited production, then they were actually very, very good at creating the flexible structures to test things, right? Santander has always been, I think, very, very good at that. So it was it was quite good. I mean, these things at banks are very different, right? You find places where everything is very formal and as it should be, right? But when you are in innovation mode and testing things and so on, you do need to have a lot more flexibility, at least for the prototyping phases or the piloting phases. So yes, we were able to put that together, and the chairwoman was very supportive as well, and she was leading many of these things actually personally. So it was good. It was not like the whole culture of the bank, but it was possible to put this in kind of innovation pockets. The case of JP Morgan, I think, is even. I mean, what they did was a very heavy lift. I mean, getting to do quorum, even the consensus algorithms and the permissioning and the I mean, that's that was huge, right? But in our case, I think it was quite balanced, right? In the end, we probably had like 10, 15 people, and then we had also some more people outsourced, right, to like body shopping. So in the end, we did have bandwidth to do a few things.
Do you think your technical background led to that environment? Because like it's hard to it's hard to launch something new, especially as you said, inside a bank. Like we talked to a bunch of banks, and a lot of those kind of ideas, they had similar ideas to you, but they died on the vine because they couldn't get support inside the organization or the resources, or there's always, you got to pull it off. And like you said, there's a balance between a very strict compliance focused organization and innovation. I'm just curious how your background played into it, do you think?
Yeah, I mean, for me, this was like the dream job, right? Because my background is very technical. Then a lot of years in the bank, and this was the opportunity to kind of mix everything together, right? And it was also a real excuse to go back to coding a little bit, and I miss that, right? Now as CEO of a startup, I spend a lot of time like raising money and talking to clients and all of that, and it's all good. But so anyway, it was great. Yes. So yeah, I think I do think having a technical background, or at least some detailed knowledge does help see the possibilities, and does help as well steer the uses, right, that this can have. Also my boss, I was referring to, Jose Maria Fuster, he was also, I mean, he was a head of technology for the technology operation for the banks, an engineer like myself, naval engineer, not telecommunications, but quite technical as well. So also quite able to comprehend the transformative potential of the technology. So yeah, that definitely played a role.
Awesome.
So maybe transitioning to the Enterprise Ethereum Alliance. So we had, as a startup, courting enterprise customers, some visibility, but we sort of we heard it from the customer side, so to speak, but not the internal in a big organization side. So I guess what were some of the challenges that you saw? I guess in part with the technology, but also just why did there need to be an EEA? And from your perspective, we saw the startup side of it, of course, but not the user group side, so to speak.
Yeah. So I think several things. One of the most important aspects was to actually have a place to meet and discuss on a collaborative fashion without having to, to sign a lot of NDAs and things, and without the fear of being accused of collusion and antitrust. And we have the impression that we were like making history, you see. It was wonderful to have a place to discuss and collectively collaborate, right, to get this thing ready for the use. So it was clearly a case of co-opetition, as in let's collaborate to then compete, right? So it was quite exciting. Then there was the need as well to help the community, to drive the community, or to get this ready for enterprise uses, right? Because the focus on public networks is clearly, I mean, at least it's not 100% the same, right? So we needed a larger number of transactions per second. We needed privacy. We needed permissioning. I think less privacy and more permissioning, frankly. And then we needed some basic things that, for example, I mean, things as simple as being able to connect to RCP interfaces using mutual TLS. Boring thing, completely useless when you are dealing in the public network, and you have your keys and that's it, right? But if you want to use these things in a way that is compliant with internal bank security policies and IT policies, etc., there are some things that you need to do, right? Remember the old debates about the the elliptic curves to be NIST compliant, and all these things. So there was a need, right, to get this ready, and also more enterprise grade, as in not having bugs and and permissioning as well. I mean, the consensus algorithms, the interoperability, so all these things that are needed, right? And probably we all felt that the public network or the general community around the public network, I mean, we always thought that they were doing an amazing job. I mean, what they did from scratch is really remarkable. I mean, even today they've not changed anything of the original Ethereum paradigm, and it's still there, and it works, right? And it's amazing, really, what they did. But when it comes to adapting these things for more regulated use and for more enterprise use, and in order to be able to use it, I mean, to connect it with existing systems, legacy systems, we all felt that this needed a specific focus, right? So it was yeah, there was a need to get organized and get to work into that, right? Probably we didn't like crack it absolutely well, right? In terms of providing the right incentives for the startups like you guys, like us, like others, to really take it like several notches beyond where we were. But at least it did help, get in the route and yeah, get going and define the things that needed to be finalized, and eventually, I mean, today I don't think we're not seeing like banks or other regulated institutions complaining about lack of maturity for the technology. So
well, yeah, I mean, it's funny that you mentioned, like, that coordination problem. Like I know in the early days, like, and elliptic curves, like how much you had to explain right from the start. I remember us having to fill out these huge security forms, and then one part would be like, what encryption algorithm that are you using? And Ethereum uses its own encryption algorithm, and then we'd have to, like, what should be one line in a form became like pages of explanation just to explain that one thing. Consensus algorithm similarly, like we had to do similar things. That sounds like you did too, with internally inside your organization.
yeah, Yeah, a little bit. Yes, we did. I think one of the things we did well was focusing on the uses and focusing on the potential benefits rather than on the technology details. I mean, from time to time, you always find people that want to know more and have things to contribute, right, about the technology aspects of that. But we had to do a lot of education around the use cases. What is this good for? What is the benefits you can expect from this? And to me, this is what has changed actually in the couple of years, specifically last year. I think was very eye-opening with the first implementations of deposit tokens hitting the market, like Citi, like JP Morgan, and you know, a number of others we at least we are working with. Now the benefits are very clear, right?
Yeah.
So the original promise, we are close to now see it, right? As they are delivered, right? Now we have Finality in production, for example. Now the first applications that are going to be using Finality as a means for clearing and settlements are about to hit the market as well. So there's now it is a lot more clarity around what are the business cases, right, to adopt this thing. Because back in the day, it was a lot more about, is the technology viable? Yeah, we give for granted that this is going to produce amazing benefits, but we didn't talk too much about the benefits. We talked a lot more about, is the technology ready? And is it scalable? Is it private, or how long it's going to take until that's the case, right? Which is not a criticism. I mean, it's just how, you know, what was relevant. Let's say, I mean, the relevant aspect we discussed back in the day.
Yeah, that makes sense.
We kind of know the why of it, but the mechanics of getting it across off the ground were at a minimum complicated. And so just to lead you, you know, a little bit, I think it started with the conversation that at least the two of you were in. I had to leave early in Shanghai, at least in large part. And then I remember a bunch of closed door meetings, mostly at the JP Morgan campuses in Brooklyn, downtown Brooklyn. But you know, I imagined that there was a lot going on the legal formation side that I think, you know, various companies donated resources to. I know Consensus did a bunch, you know, JP Morgan did some. I'm curious, like, your recollection of that. You know, for the listener, it's getting a consortium off the ground is a big pain, and that all the documents have to match, you know, and so they have to be acceptable to everybody. Just from your side, you know, we never really saw into, again, the corporate side of it, and you know, what your experience was like just getting the thing off the ground, your part in that, and also getting the organization's buy-in to participate.
Yeah, my recollection of that is that it was exceptionally productive and easy, at least in comparison to others. I mean, bear in mind that I was one of the 6 MDs that got the original arrangement in R3. So that was months and months and months. I mean, that was a lot more. Of course, I mean, in this case, in the case of the EA, there was not money involved, right? There was very, very little money involved, right? It was not like, you know, millions per bank involved, right? Utility settlement coin that later became Finality. That's also a, you know, big consortium that required funding, etc. So, you know, when there's funding involved, I think things tend to get more tense and to take longer and all of that. In this case, there was really no opposing interest, right? And there was really no it was a lot of enthusiasm. I remember Jeremy Miller saying, amazing. I mean, we got more done in one day after one meeting than, you know, other people in like last year, right? So we did have that feeling. Actually, it's in Shanghai to founding of the EEA. I think it was like a couple of months or three
Yeah.
months in regulated world or in enterprise world. That was really fast. I mean, we took 2 or 3 more meetings. I remember going to New York and a few times, and then we did it. We didn't really find a lot of opposition within the bank to join. Yeah, it was a little bit of a cost, a membership cost, but quite a small, and not really a lot of legal stuff to go through it. And everybody was very, yeah, very interested in this idea of collaborating to compete later on. So my recollection is actually quite positive. I think we got a lot done actually in very little time. Yeah.
Yeah, I mean, I think what I remember is that, and I'm curious from your point of view too, is that, a bunch of companies and ourselves were having conversations with the Ethereum Foundation. Like I know that, Matt Spoke, who was at Deloitte at the time, they went on to do Newco, and like you said, Jeremy Miller, and who was chief of staff at Consensus, and all of these people were kind of talking to the Ethereum Foundation. And I remember us kind of like learning, probably at Shanghai, that like Vitalik was like, you guys figure out this enterprising part. Like that's not what I'm going to focus on. And at that point we kind of realized, okay, we got to take this over and kind of work on it together, as opposed to relying on them to help us kind of organize. Do you remember that?
Yeah. I I kind of had the same on this side of the table, and it was good. Actually, we were collaborating already with Consensus. Consensus at that time was doing some or a lot actually of enablement work,
Yep.
right, for banks. So they would help create capabilities, and they were very good. They had very good people, and very good, very sympathetic, very knowledgeable, obviously, but then quite interested to help. I mean, not to change everything within a bank or within a regulated institution. So I remember Jeremy's work on this and Consensus in general. The work was amazing. You guys as well, Blockups as well, was quite instrumental on that. But yeah, I mean, I think he did a great job at instigating, and then steering, right, the conversation towards the objective of incorporating this, and I think it worked out really well.
Yeah, I remember those early conversations in those early conversations we were having with you, and that were kind of previous to that, just talking on the things you were working about, and that kind of led into Shanghai. I do have to mention, the big announcement that Santander had at Shanghai was that you were going to put cash, you were going to be a bank to issue cash on the chain. So can I call you the father of stablecoins? Like, would that be okay? Because really, you guys thought of it, like, I think you thought of it first. Like, it seems obvious now, but like, you didn't even have a term for it at the time.
Oh, the proper term has been given by JP Morgan again, which is deposit tokens. That's what
Yeah.
everybody understands. We used to call it, I think we've even called it stable coins at some point, yeah, but we called it digital cash, tokenized cash, then tokenized deposits. Now deposit tokens. I mean, it's always the same thing. It's this idea of creating regulated bank money from a banking license, but using a smart contract on a blockchain network, right? Anyway, you could call me that if we had put this in production, actually, which I don't think we did, at least that year.
Well, at least you are one of the parents of stablecoins, I would say, like, because there aren't too many people back then talking about it. Like, it's kind of amazing. Like, as I
Yes.
kind of went back,
And
this was back
and
in 2016, right?
yes, and we did have prototypes, and interestingly, the vision, if I compare that with the vision we have even still today in Adhara, is very similar. It's this idea of creating client money on smart contracts, so it works in real time, so it can work 24/7. You can extend operating hours. These are the the reasons why Citi is doing deposit tokens for clients, for example, right? To extend operating hours and making it work more seamlessly and efficiently in payments and other types of applications. So we did have that idea. I mean, we don't. So essentially, I mean, our reasoning was, what was the point of stable coins or crypto? Is it the real-time nature, the programmable nature, the accessibility, the security model, right? Using your keys instead of third-party authentication, blah, blah, blah. Is that the key? Or the key is the unregulated nature, as in you want ways to own money in an unregulated fashion, right? Because if it's the first, right, then the idea of doing this from a banking license or maybe from an electronic money license, if you want to, like, you know, ring fence things a little bit or even do it with, you know, lower regulation or something, then that should do, right? Because a deposit token, you know, you can transfer it, if you can put it on hold, you can earmark it, if you can, you know, once it is on a smart contract, then you can couple it with applications. So that should be equally good, right? So if the problem is the programmability and the accessibility and blah, blah, blah of the money, then this thing should be as good as a cryptocurrency. If the problem is the regulated nature that makes you go through KYC and through, you know, and then sanction screening and AML and blah, blah, blah. If that is the problem, then, you know, a bank is never going to be able to get rid of that, right? Because, you know, you have to control the money and you have to prevent, you know, terrorism financing or money laundering and all these things. So I don't know. I'm less, and we were less of the opinion that and regulated assets should be used for regulated worlds, and more of the opinion that the programmability and the you know, the technical aspects of the constructs are really what brings value, at the very least for banks, in terms of making them more efficient and the financial infrastructures. I think the you know, programmability and these things is really what makes the difference. So the natural step was to focus on commercial bank issued money. The same way we try to do the same with central banks, but then we found a way to do that through Finality. I mean, as a consortium, rather than trying to convince a central bank to do issuance directly by themselves, which I still think will happen someday, but maybe we'll retire before that happens.
Well, it's funny though that, like, you know, I mean, you look back at these things, but like, and how much creation was going on. But I remember talking to you and John in Shanghai and said, like, what do you mean? Like, when you're talking about digital money, what do you actually mean? And you were like, well, the bank acts as a custodian. We provably have this money in the account, and then we make it appear in a smart contract. But that architecture is effectively what every asset-backed stablecoin uses today. Like, you guys really figure that out in a way that, you know, I don't think people give as much credit for in the crypto community, because that took a lot of thinking, and I think it had to come from someone who had the kind of institutional knowledge that you guys had in order to do it.
Yeah, you're probably right. In the last years, we typically distinguish. I mean, from a technical point of view, that's very clear. The point is the legal point of view, right? So if you are not a regulated institution, it is actually illegal to do that, right? But you can be as loosely regulated or as lightly regulated as an electronic money entity, right? There are jurisdictions where you can have an electronic money entity. That's not a full banking license. That's simpler to get and simpler to manage. Yes, these are assets that are backed by an omnibus account that you have with a bank, right? And depends on the regulation in different places, but essentially it has to be one-to-one and so on. So that's good for many things, right? And we've done, you know, tons of experiments on that. Lately, I think banks have understood that they can take this one notch farther And instead of using this backed construct, what they can use is what we call a native construct, right? The backed construct is what we normally call a tokenized construct. So you have an omnibus and then that backs the tokens. In the native construct, you can get a bank to create the money directly on blockchain as part of their balance sheet, right? So you go to a bank, you ask for a loan. The bank is going to annotate the loan, that's their asset, and they're going to issue the money to you in the core banking system, and that's their liability, right? So you go to a bank, you ask for a loan, and then their balance sheet goes up, right? More assets because they have a bigger loan or bigger loan book, and more liabilities, right? Because they just credited you the money. The money is created like that out of thin air in a bank balance. Now, you can create as a bank, if you're a bank, you're not a bank, this is not true, but if you're a bank, you can create actually this money directly on the smart contract. So essentially, you're using the smart contract as an extension to your liabilities ledger, to your core banking system, right? And there are tricks to like mirror and blah, blah, blah to do reporting, etc. But in essence, you are creating cash on another technology substrate that simply extends the liabilities ledger database that you have today. So that's not backed, right? Well, the cash is backed, but it's backed by the full balance sheet of the bank, you see. So at that point, this is really a deposit. It's not
that's really
a stable coin. It's actually a bank deposit. It's legally as a bank deposit. It's not a and it's not crypto, right? It doesn't need like new regulation or anything like that. It's just banking law. It's under IFRS or US GAAP. I mean, it's considered a deposit. We've seen banks signing up for that, right? And it's it's even more exciting. But the standards, the programmability, all of that can be the same, right? It's more about the legal construct, really, the debate that has been clarifying, right, over the past years.
That's really exciting.
Yes.
That's a big move. Yeah.
One thing I've observed over the years is that the industry, I mean, obviously it waxes and wanes, and it was always the case that the more crypto use cases were kind of shinier and got more attention. And enterprise was always sort of slow and steady, if you will, each year, getting a little closer to the end state that you're describing, so to speak. But as you look back on it now, do you think, I mean, I would say 5 years ago, I wouldn't have believed that the enterprises would really engage at all with the public blockchain, or to a very limited degree, maybe. And today, it's less clear to me. I think it's still possible that things are definitely still missing, but it's possible that the development that's going on there will end up solving, enough of the problems so that there's not really a separate enterprise blockchain category, if you will. What is your outlook on that question?
I must confess that I'm not entirely up to date with the developments in the public network. I mean, we were so busy with so many things going on in the specifically in the regulated world, and here, it's always about private networks, right? Even the first kind of consortium constructs will start with permission networks that over time will open to decentralized governance, as in different institutions running validators and having governance algorithms to vote in new validators, to vote out, and things like that, right? So still far away from needing anything, let's say, from the public network, and definitely not in a position to start like issuing things on top of the public network or anything. So because people are just so focused on getting the first things off the ground, and it's so much easier, right, to do it with this type of things, even though you don't get kind of the full benefits from decentralization and trustlessness and all of that, right? I think everybody gets that. having said that, the ability to use the public network, the level 1 network, as a way to anchor permission networks through different constructs, etc. I think this is something that that has legs, right, and can be instrumental, at least at a later time when there's a clear need for scalability. Right now, all the first use cases that we've seen and we've been working on, etc., or we are seeing people work on, etc., there's been no formal complaint about scalability. You know, as in the wholesale financial world, you don't need, you know, thousands of transactions per second, as if we were talking about credit cards or retail payments, right? Something like that. So the need has not reached that state, let's say. I think the work that has been done over there is quite promising, right? I don't think it's been written off by banks, as in this will never work or this will never be compliant or anything like that. I think it's just not been the focus, right? And kind of the same for privacy. I see people imposing privacy restrictions based on rule books, essentially through legal constructs. In fact, I see people favoring more visibility rather than privacy. Remember that lack of visibility is what got us into the credit derivatives crisis a few years ago. So yeah, I think it's a similar concern, right? As I said, I'm not entirely up to date. I mean, John always tells me that I have to catch up on this, as he is very much on top of these things. But it's not because I don't believe in it. It's just because we're just so busy with the first things and taking the first things over the line, and it's just so much easier, right, to do it in permission network terms. Mostly because it simplifies governance, right? It clarifies governance, clarifies who's responsible for what and who has to put out, or you know, who has to do which rule books, right, and to provide rule books to whom and so on. I mean, the legal construct is always the key to get these things off the ground in the enterprise, or in the regulated world.
It's funny, you know, you talked about government, and to jump around a bit, like I remember, I think one of the things you said about the EA is it allowed companies to collaborate. And I remember one of the first big projects we worked on with you and Microsoft and JPM all together was around governance. Like, how do we create a smart contract governance system? And in my recollection, and Karen, maybe you could correct me, I think that all happened incredibly fast. Like once we had the construct like EA where we were allowed to collaborate, I think we had that first prototype in a couple months too. And if I recall, you demoed it at Consensus, right, Karen? Was that right?
Yeah, so we demoed some of it. So I think, I'm trying to remember, was this 2017 or 2018?
Yeah.
It's long enough ago that it's all a blur. But yes, we definitely, so the EA is up and running, what, end of February 2017, I think. So it could have been the same year, or
I
it could
think it
have
was
been like
I feel
early
like
into
it
the
was the
next
same
year.
year, at least when the work kicked off. Like, yeah, I don't know if you remember, Leo, but I do remember that project and us like being surprised that we could work together so seamlessly.
Yeah. That was again, there was an example, right, of something we all knew that we needed, and so it was about time to get together into that. It was difficult, right, because you always have to find a way that kind of satisfy everyone and all of that. But yeah, the need was clear, and I recall the group being very energetic around trying to find solutions, or at least to agree on a definition, right? So
And I think, you know, some of those again, like I think the concepts that we created have been widely adopted. Like you can see this in things like governance DAOs, these kind of things. Like we created those concepts and they've kind of been widely adopted in the broader ecosystems too. Like there are plenty of, projects that are using sort of DAO-like governance, voting in validators, voting in parties, voting out parties, all of those kind of things on the smart contract level.
For the projects, so you've been involved in a number of these consortia with, and then let's maybe expand it to, when you're working with a bunch of different enterprises. So I'm not sure if, you've formally, obviously you're working with some of the consortia at Adhara, but I don't know if you'd call your work a consortium. I think, you guys are a tech company, but what's for the ones that have succeeded, and there's lots of news for the ones that failed, especially more last year. You saw a bunch of high profile ones, Liquidate and this and that. What's been the thing that has kept them going? Because it's some of them are really a slog, and to your point, especially when there are opposing commercial interests. If you were, what are some of the lessons that, if you were to kick one off today, you'd do differently, or what keeps them marching along on this hard collaborative task?
You're specifically talking about Finality?
Potentially, but given that you've been involved in a few, I guess, any general lessons?
I don't know. I mean, it's really hard work and really frustrating at times. A very important aspect is ensuring alignment of interests. So you need, I mean, this is fairly obvious, right, what I'm saying, but consortiums work well when there is a good common benefit that is being pursued, and also when there is a good alignment of interests between the people that are going to be promoting or facilitating the creation of the consortium or the governance of the consortium, and the participants that are going to be funding it or doing things, right, or participating in that, right? The case of Finality, I think, is a very good example. The benefits, I think, were clear. The reasons for doing this were clear. They were not competitive, at least not for the banks that first joined this or are still joining this, right? There may be other banks, like really big banks, that would like to capture all the value by themselves. That may not be of that opinion, and hence they are not in Finality, right? But at least for the initial members and the subsequent members that ended up joining, I think it was good alignment, right, in the potential benefits that this could bring, right? In other cases, I've seen consortiums fail or not get traction when there's no clear articulation of the benefits, right? It's not clear what is the reason for doing this. So when the reason is just like too general or too kind of, taken for granted, then, at some point you say, okay, well, what I'm doing here, why am I spending time on this? And then if there's some money needed, then it never goes through any toll gate for senior stakeholders, etc. Right? So to me, I don't know. I mean, it has to be clear that what is the objective, right? What is the benefits that people are supposed to get from this, and it has to be clear that there's no competitive dynamics between the members. There's a shared goal, right? So it's a common goal that is going to make everybody benefit from it, right? I know what I'm saying is fairly common sense, but you'll be surprised, right, when you read.
No, yeah,
I don't think it's common sense at all, Julio, because like you have more experience building these blockchain concerns than most people on the planet, and I think most people in the public blockchain world think oh, if we build the technology, then all these other problems will just solve themselves, right? Like like I admit I sort of had that attitude myself before getting into the whole process of starting EEA, like that it was mostly a technology collaboration problem and not the alignment problem that you're talking about.
And
Yeah.
usually there are at least 2 or 3 types of player in a consortium. There's tech vendors to it, there's end users of it, and then the end users may have different types of interests depending on the type of business you're in. Like we worked on, cases in like the energy industry where you have, people who get the energy out, and then there's people who manage the data associated with it, and then secondarily other tech vendors. And then there you see a sort of them against us kind of mentality where people are trying to shift margins around, et cetera. So to your point, it may appear at the outset like, yes, this would just be a great thing to have a standard for everybody and it'll just smooth everything out. But often parties best benefit disproportionately, or there's an attempt to remove a whole class of actor, and sometimes that can work, but yeah, no, tough going for sure. And part of the challenge also is the ones that have more of a zero or one structure, i.e., if everyone has to participate for it to work, it's pretty hard to sign everyone up at the same time. You can get that to happen, but the hope is that you get some benefit from a core group, and then it's so compelling that people join later. I found that a bunch of them have that problem where you've got incomplete data, or you need a second system or the legacy system to make it work for everybody. And so there's just this huge hurdle to leap. That's another failure mode. They're definitely tough, in my experience as well. All right. I think we're in a good spot. I don't know, Julio, do you want to tell us just a little bit more about what you're doing at your current company and maybe leave us with any kind of sign off notes? I don't know, Victor, if you had any more questions also. But I feel like
Yeah, no, I just wanted to hear, yeah, like what you're doing at your current company, like we said, like you were there at the beginning, you established a lot of these things and you're still working at it. So, what gets you excited? I'm assuming those are things that are happening at your current company, but whatever you can talk about, or even more generally, I think.
Yeah. So in Adhara, I think I left Santander, I think 2018. So that's when we launched Adhara, like in July 2018. So it's been already 5-6 years. And frankly, I think the vision still remains quite the same, quite consistent versus what we thought in the beginning, and even what I was interested in when I was still part of Santander and launching the EA and all of that. It's essentially about helping banks bring to fruition this notion of tokenized cash. We specialize a lot on the tokenized cash side, and create the tools that they will need to benefit from that, right? In the beginning, we concentrated a lot in mobilizing the team and creating the first reference implementations. We were hired by Finality, as you probably know, to provide all the the stack to create the smart contracts, tokenizers, gateways that are needed by banks to connect into Finality and other blockchain layers. So that took a good time. Then we started thinking and working on applications of tokenized cash, right? We invested a lot of time on payments as in client payments, from bank accounts to bank accounts. We then started exploring the idea of using tokenized cash as well for end clients, right? in the beginning was more about wholesale settlement, really what the tokenized cash was going to be applied for, like Finite. And Finite is not for people. Finite is for banks, so they can settle with each other, right? So that was the first application, but then later on we started to apply the same concepts between in banking groups that have different subsidiaries and different branches, just to do intra-group settlement, intercompany settlement, right? Imagine different subsidiaries in a bank or different branches in a bank, right? I still recall, JP Morgan was one of the first intentions, right? Precisely to do internal flows within the group using JP Morgan Coin. That was the original idea of JP Morgan Coin, as per the announcements. So we explored all of that. Then we got into applications like payments and others in capital markets like DVP of securities. I mean, it's always been quite focused on the cash leg, right? Both central bank, so interbank, central bank, wholesale, central bank, wholesale, commercial bank, and now more recently as well, even client cash as well. I think we've been quite quite specialized on that, as this is what really enables a lot of these things, right? Now there's a lot of our activities related to deposit tokens. Last year, I think it was a phenomenal year for the consolidation of the concept. We don't work for Citi or for JP Morgan. We'd love to, but the reality is that they do their own technology. But the fact that the idea is the same, the underlying technology is Ethereum as well. Now everybody's quite interested in the interoperability patterns that will make possible to do like atomic settlements or cross-chain settlements and these things. So that was great because it fixed the same terminology. We don't have to explain what we mean by tokenized cash anymore. It's just the same deposit tokens. There's a name for it, which is wonderful. But the really important thing is that now, and after all the POCs and all the education that we've been doing throughout the years, and also based on the work that Citi and JP Morgan and others have been doing, it's very clear what the benefits are, right? Yeah. So now you know that you can use this. Imagine a bank that has a number of branches and subsidiaries, and they're still doing the intra-group flows. Imagine a payment that starts in a client of one subsidiary sending cash to or paying a provider that is in another branch of the same bank in another geography. Many times they're still using different banks to do the internal flows. So every payment has to go through two correspondent banks, and they have to fund those accounts. So that's a funding cost, and that can be tens, if not hundreds of millions in financial costs for banks. So now with deposit tokens, you can internalize these flows, and you can do intra-group settlement in a much more efficient way, right? So you can lower the need for accounts and for funding at correspondence. You can reduce the number of relationships that you need, and also optimize the cost of funding, for example, right? Some other times it's about extending operating hours. So being able to offer payment services on a 24/7 basis. Right? Today, imagine a bank needing to send a payment from New York, then settling through London and Singapore, and then finalizing the payments in another bank in Tokyo. So the chances that the core banking system is open at the four places is zero, right? So that's why it goes in batches and takes days, and then these things get lost, and they have, the messages get lost, and they have reconciliations, and they fail, and blah, blah, blah. So the ability to use deposit tokens is a means to extend the operating hours and make this work overnight. That's great, because with this you can actually do payments in different jurisdictions at the same time, right? In a given time. So you can offer much faster and much more certain payment services, right, and treasury services to your clients. So now I think the benefits are clear, right, and it's all about just refining the business cases, see how much money you're going to be saving or how much more money are you going to be making. And then it's a clear case for adoption, right? So we happen to be the, probably the only company with a fully packaged solution for deposit tokens that's you're likely to need if you're not Citi or JP Morgan. So that's what is keeping us most busy these days. Of course, we keep helping Finality, and now we're working very intensely on the first applications that are going to be using Finality. So we work with FMIs on that side. But deposit tokens is a very exciting opportunity right now. That's mostly what we are focusing on these days.
That's great. Well, I'm glad that you continue to work on it. And as we said, you were there at the start, and you're kind of the hard work is getting things through and getting things into production, right? So I'm glad that you are bringing all your knowledge and experience to that.
Yeah. Thank you. Just getting closer and closer, hopefully.
It does feel, I don't know if you feel this, but it does feel like things are kind of accelerating. Like all of those things that kind of like, getting the benefits clear, getting the technology working, getting, how to do it in a compliant manner. All of that was sort of like the pre-work that, really is kind of opening the door to adoption. And it feels, at least to me, like things are accelerating.
I think so as well. It's been a long road. It's been a long journey. It's still super fast in regulated institutions' timeframes. I mean, in central bank terms, getting Finality from concept from incorporation to production in 4 years, 4 or 5 years, it's super fast. I mean, Finality was incorporated in I think it was April 2019, and it went live in November 2023. So it's slightly over 4 years. So in central bank terms central bank timings is like super fast, right? Like really fast. But anyway, I mean, when you're in a startup, things never go as fast as you would like.
It never feels fast enough, right? But
Yeah.
but I think if you look at it, like you're right. Like I remember when we were talking to banks and realizing a lot of their core banking systems were still written in like Fortran or something, like it was just very like the technology adoption is really slow unless you have really clear benefits, which it's clear that you guys do. So that's awesome.
All right.
All right. I think it's a good note. You want to close it on that, Vic?
Yeah, I will. So thank you.